What if I told you that some of the absolute biggest, most profitable trades of the day happen within the first 15 to 30 minutes of the market opening? Well, welcome to this explainer on the ORB strategy. This is a classic, really powerful method that professional day traders have been using for decades to capture massive moves right at the opening bell. Today, we're going to break down exactly how this works, using nothing but the raw data and chart structure to guide us.
Now, it's one of the most popular strategies out there, mostly because it offers a clean, straightforward setup almost every single morning. But here is the harsh reality. Most beginners fail spectacularly with it. Why? Well, because they treat it like a cheat code, basically trading blind right into institutional fakeouts. Trust me, the smart money knows exactly where your stop losses are hidden. So in this Masterclass explainer, we are going to cover the ORB strategy mechanics, defining your opening range, breakout versus retest entries, avoiding those painful fakeouts, layering in smart money concepts, and finally, protecting your capital with risk management. Let's get right into it. Starting with Section 1, the ORB strategy explained, and why those first 30 minutes are so crucial. Let's look at why the market open provides such a completely unique trading opportunity. The whole ORB strategy capitalizes on the massive wave of liquidity that institutions inject right at the opening bells. Whether we're talking about the New York Stock Exchange ringing at 9:30 a.m. Eastern or the London Forex Open at 3 a.m. Eastern, this is when volume and volatility are at their absolute peak. This sudden, massive influx of institutional money creates these huge directional pushes that we want to catch. Moving to Section 2, defining the opening range so we can escape the chop zone. To actually execute this, you first need to define your battlefield by marking out your opening range. The space between the high and the low of that initial opening period is what we call the chop zone. During this time, price is just bouncing wildly back and forth. It is absolutely critical that you sit on your hands here. You do not take a trade inside this range. You are waiting patiently for the market to formally declare its direction by breaking out of this box. Now, while some traders use a really fast 5-minute chart and others prefer a wider 30-minute chart, the 15-minute ORB is definitely the industry favorite. It perfectly balances risk and reliability. The steps are super simple. First, wait for that very first 15-minute candle to fully close. Second, mark a horizontal line at the top wick and the bottom wick. The wicks are critical here. And then, you just wait for the breakout. Which brings us to Section 3, breakout versus retest entries. Choosing your attack. Once price finally leaves that chop zone, how do you actually jump in? Well, there are 3 primary ways to enter, and they carry very different levels of risk. Option 1 is your direct breakout. You enter the exact second a candle closes outside the range on above average volume. But remember, it must be a full body close, not just a wick. This is aggressive though and carries a pretty high fakeout risk. Option 2 is the break and retest. This is the more conservative, higher probability approach that the pros love. You let the price break out, and then you wait for it to pull back and test that previous range border as a brand new level of support or resistance. Then we have the third option, which is the confirmation entry. For the ultra-conservative traders out there, you wait for that retest to happen, but you only enter when the price subsequently breaks the new high created by the initial breakout. Now, while this gives you a ton of safety, the big downside is that your entry is much further away, which definitely worsens your overall risk-to-reward ratio. All right, Section 4, avoiding fakeouts and traps, or why blind trading fails. Here is where the pain really starts for amateurs. Treating the ORB as a blind cheat code without any broader context is basically a guaranteed way to blow up your account. And the numbers mathematically prove exactly how dangerous this is. A blind ORB strategy backtest on gold over just 8 trading days shows exactly what happens. By simply buying every single upside break and shorting every downside break without any context, the result was 5 brutal losses to only 2 wins, leaving the trader in the red. Institutions are deliberately faking these breakouts to trigger your entries and snatch up your stop losses. Smart money knows you're drawing these 15-minute boxes. Often, the price will break out of your range for one reason only: to tap a previous day high or previous day low liquidity pool. Once it grabs that liquidity, it'll aggressively reverse right back into the range and stop you out. If you don't know where those major daily levels are before taking the trade, you are literally walking straight into a trap. That leads into Section 5, smart money concepts in context. This is how we stack our edge. To fix that dismal win rate and stop getting trapped, we have to layer our ORB setup with higher time frame context.
You have got to stack those confluences. First, always align with the 1-hour or daily trend. If the daily trend is bullish, we are only looking for upside breakouts. Second, never take a breakout straight into a major supply or demand resistance level. And third, use simple indicators to help confirm the move. A 9 and 20 exponential moving average crossover happening right at the breakout gives you fantastic immediate momentum confirmation. Now here is where we can integrate smart money concepts to find those truly elite setups. Watch closely for an impulsive breakout that creates a fair value gap, which is basically just a sudden imbalance in price. If that gap overlaps perfectly with your ORB line, you have a golden opportunity. When the price pulls back to retest and hits both that fair value gap and your ORB support level at the exact same time, you've just found a high probability setup with multiple, powerful layers of confluence. Finally, Section 6, risk management and stop losses. Because even the best smart money setup in the world will fail occasionally. Your trade is truly only as good as your risk management. So let's talk about where that stop loss actually goes. You can place it just below the breakout signal candle for a really tight risk, which gives you a massive potential reward. Or you can place it more conservatively on the complete opposite side of the entire opening range. That wider stop is super useful when you're dealing with the heavy whipsaw price action you often see in Forex markets. And please, as a golden rule, never risk more than 5% of your total capital on a single setup. Furthermore, you've got to anchor your trades to a minimum risk-to-reward ratio of 1 to 1.5. Meaning, if you're risking $100 on that stop loss, your profit target must be at least $150, ideally way more. If the chart structure or an upcoming resistance level doesn't give you the room to make that 1.5 minimum, simply skip the trade. There will always be another setup tomorrow. As we wrap up this explainer, the single most important takeaway here is patience. The ORB is not a get-rich-quick button. It's a structural tool. So I'll leave you with this to think about. Tomorrow morning at the opening bell, when the market is flying and the adrenaline is pumping, are you going to blindly trade the box and become institutional liquidity? Or will you have the discipline to wait for the context, wait for the volume, and wait for that retest?